Okay, we're going to continue with our discussion of financial accounting with Chapter 3. And we are using the mini case that we started on in the Chapter 2 lecture. It's the same case, but now on mini case in Chapter 3 adds some projected values for 2017 on the balance sheet and income statement, etc. So you'll see there's a column called 2017E. Looking at page 134 in your book, of course. If you're using the online book, just go to the bottom, Chapter 3 contents, and click on the mini case to bring it up. All right, so using those, we are going to make some comparisons, right, of this company Computran, its financial health, its financial strength. We will be comparing that to industry averages and of course over time. So we are looking at these financial statements and drawing some conclusions from it by computing some ratios. We did compute a couple ratios in the last chapter, but we are going to compute a lot of ratios in this chapter. The DuPont analysis will show us where the value added to the company comes from. Does it come from its operations, or does it come from simply financing activities? Right. Then, of course, we are going to look at what ratios over time tell us whether they're improving or not. Right. There's, of course, we will talk about the limitations of ratio analysis and some qualitative factors that will not be captured by ratio analysis. So that's the topics that are covered in this chapter. And you've seen this before, right? This value of a company is based on free cash flows and in the future, and we calculated their present values to decide how much a company is valued today. So amongst all these components, we are going to focus on NOPAT, net operating profit after taxes, then required investment in operating capital, the firm's debt to equity mix, the business risk that the firm faces. So debt to equity mix is an analog to financial risk, and the business risk is the risk of from operations like fluctuating sales, rising costs, etc. All right. So what are these ratios good for? Well, they allow us to compare one company and its finances over time to see whether it's improving or declining, right? But also we can compare one company versus other companies that are in the industry to see, relatively speaking, if this company is financially sound. Who uses these ratios? Well, lenders. They use ratios, financial ratios, to determine creditworthiness of a company. Stockholders use the ratios to estimate future cash flows and risk, and then decide how much they're willing to pay for company stock. And managers use ratios to identify areas of weaknesses and strength to figure out where they should focus their attention on. Right? And of course, these are the values given to us in the case. The sales, we already had 2015, 2016 values in the last time. And now we have 2017 expected values. And that's basically because the time this was created, the year 2017 had not ended yet. So this is the ending value for 2017 that they anticipate. Half of 2017 may already be over. Based on that, they can make projections of what those the ending values of these various items will be in 2017. Of course, we're looking at income statements, so we're talking about sales that will be made throughout the year of 2017, right? Not just a one-day sale. Remember, that's the difference between income statement and balance sheet. In balance sheet, we have values that have been accumulated over time and since the inception of the company. And so those are stock variables. The income statement just tells us what happened this year, right? And to get that kind of answer from balance sheet, we'll have to compare one year versus next to figure out, what happened during the year. Anyways, so flow variable and income statement, stock variables and balance sheet. Okay. All right. So based on these numbers, we are going to be calculating some ratios. Here's the balance sheet. We already had 2016 numbers, and now we have 2017 expected or anticipated values. Right. The other side of the balance sheet, liabilities and equities. Right. So we're going to be using these numbers to calculate some ratios. As of other data, which is not typically a part of balance sheet or income statement, but it is reported usually separately. So we got $12, and the stock price is expected to have gone up. So at the end of 2017, it's going to be $12.17. More shares have been sold. So there's $250,000 shares outstanding, whereas before it was 100,000. So 150,000 shares have been sold. The company sold an extra 150,000 shares. The earnings scenario has definitely improved because whereas previously earnings per share was negative, there was 100,000 shares outstanding, and the company had made a loss of 95,000. So we had EPS was negative 0.95, and now we have 250,000 shares outstanding. And the income statement shows us that the net income expected for 2017 is 253,584. So if you take that 253,584 and divide it by 250,000, we get 1.01. That's so earnings per share is turned positive and has shown a big improvement. And the company goes back to paying 22 cents per share in dividends. If you might remember, in the last lecture, we were looking at the numbers from 2015 and 2016, and the company had lowered its dividend payments from 22 cents a share to 11 cents a share. But now that things are looking up again, the company is back to being profitable. It raised its dividends back to the original 22 cents a share. Right. Book value per share is basically the amount of equity in the balance sheet. So you will take the retained earnings, and that's 292,000. I'm sorry, retained earnings 296,216, but common stock now is 1,680,936. So if you take, I'm reading these out of the balance sheet that I'm looking at in the book, and so if we add those two, common stock, the 100, actually now we have 250,000 shares, and it's what, when the company sold those, they got 1,680,936. There's retained earnings of 296,216. Add those two, your total equity is 1,977,152. When you divide that by 250,000, you're going to get $7.91. So that's the book value per share, right? And as we know, that's not the same as the market value. because stock price is 12.17, so market value per share is much higher. Then this is some off-balance sheet items like lease payment. Lease payments do not, they are financial obligations, just like interest payments. The company must make those lease payments, but they don't appear in the balance sheet, so sometimes it's reported separately. Of course, the tax rates remains the same, 40%. Now, so we are going to start to compute different ratios and use those to get some answers. Can the company meet its short-term obligations using the resources it currently has on hand? Right? We use a bunch of ratios. We call them liquidity ratios in order to get those answers. And here are a couple of those. The current ratio. Current ratio is the total of current assets divided by current liabilities. And so if you look in the balance sheet under asset side, there's cash and short-term investments and accounts receivables and inventories. All of those are counted as current assets, and you add the total sum of those are labeled as total current assets, right? So you take those total current assets, divide by current liabilities. The current liabilities in the balance sheet is going to be accounts payable, notes payables, and accruals. Those three added up. So those, and if you remember, the name current comes from the fact that these are going to have to be liquidated very soon. So current assets will yield cash within the next year, and current liabilities will necessitate the use of cash over the next year. So if we get more coming in with current assets, which is the case here, right, for 2017 is 2680. Total of current assets, this is, in thousands of dollars. So in the balance sheet, it's actually 2,680,112, but they're just rounding. This is being rounded to thousands of dollars. So 2680 over 1040, you're going to get the 2.58, right? That's the current ratio for 2017. But the current assets includes inventories, right? Inventories get liquidated only when a sale is made. What if, your inventory consists of obsolete items that cannot be sold? So another measure is quick ratio. Now, quick ratio is current assets minus inventories, right? Current assets without any inventories divided by current liabilities. And when we compute that, the answer is 0.93. So 0.93 is the quick ratio. And of course, that's less than 1. We want it to be more than 1, typically, unless you're looking at special situations like financial companies, banks. Banks usually have their assets and long-term loans and mortgages and car loans, etc., but their liabilities are short-term, such as checking and deposits. So that you can expect for banks to have less than 1 in current ratio or quick ratio, etc. But for manufacturing companies, you want these numbers to be greater than 1, and the greater, the better, right? So looking at the current ratios for Computran and quick ratio of Computran over the years, we see that 2016 was typically a pretty bad year for Computran. Its current ratio declined, then it picked up, quick ratio declined, and it picked up, but quick ratio is still less than 1. Current ratio is also 2.58, less than 2.7, which is the industry average, right? So it's less than both. The liquidity situation is not quite up to par with the industry, although it has improved, right? So it's expected to improve because this 2017 numbers are expected numbers. So it's expected to improve, but still below the industry average. So we would say that the liquidity position is rather weak for this company. Then we'll look at some asset management ratios. That's going to tell us how efficiently the firm uses its assets. How much does the firm have tied up in assets per dollar of sales? So we're going to be looking at ratios we call turnover. So there's an inventory turnover ratio, and for that we look at cost of goods sold. Cost of goods sold is simply the variable cost from the income statement. The first item of an income statement is sales, the second is cost of goods sold. So cost of goods sold is 5.8 million. Of course, these numbers are in thousands. So 5,800. These are 2017 expected numbers, but 5,800 plus 120 divided by 1716. Right. So basically, it's a cost of goods sold is the total cost, which includes depreciation. That 120 is depreciation. In the income statement that's given to us, we have cost of goods sold except depreciation, and then depreciation given to us separately, and we basically just need to add the two together for calculating this inventory turnover ratio. Right? Then we divide that by the total level of inventory, and that comes from balance sheet. The top item comes from the income statement. The bottom item comes from the balance sheet, and we get 3.45. And what this essentially means is that we're able to sell all of our inventory 3.45 times during the year, right? So you get a bunch of inventory, which will be, number is 1716. So we have inventory worth 1.716 million. Remember, these are in thousands. So we have 1.716 million in inventory. We sell that, we get the same amount in inventory again. We sell that, we get the same amount of inventory again, and we sell that. We can do that 3.45 times during the year. And that's what inventory turnovers have. And we want this number to be high. We want to be able to create a lot of business and sell a lot of inventory, right? Inventory turnover for the company Computran had gone down from 4.03 to 3.96, but even with the improved outlook, in other terms, the inventory turnover for Computran is expected to decline even further, and it remains far below that of the industry average, right? So this is not looking good. Inventory turnover is below industry average. The company may have old inventory, or its inventory control process is poor. So according to our forecast, there's no improvement, just a decline. Another asset management ratio is day sales turnover, or day sales, average number of days from sale until cash is received, right? That ratio is calculated by taking the amount of accounts receivables and dividing it by average sales per day, right? So it's a measure of how fast we are able to collect on our credit sales. If you remember, accounts receivables are generated due to sales that are made on credit, right? And we divide by average sales per day, so that's total. We take the annual sales and divide the annual sales by 365, because there are 365 days in a year, and we get the average sales per day. So take the total amount of accounts receivables divided by the sales, that average sales, which is annual sales divided by 365. And for 2017, we get 45.5 days. And it basically tells us that if once we make a sale on credit, on average, it takes us 45.5 days to collect on that, to get cash for that sale, right? So the company's collecting too slowly, and you can see that it's actually, once again, it's forecasted to become worse. It was 37.4. We want this to be, this number we want it to be really small, right? So it was 37.4, went up to 39.5, and we forecast it to go up again to even, it go up even more to 45.5 days. And that, of course, is not good. Industry average is 32 days. The company's credit policy is probably very lax and poor. Then, we'd already seen a turnover ratio and inventory turnover, but we have fixed assets turnover and total assets turnover. So now, for these turnovers, we don't use cost of goods sold, but rather sales, right? Sales divided by net fixed assets is the fixed assets turnover. So take the total sales, again, that comes from income statement, right? Net fixed assets comes from the balance sheet. On the asset side, it's gross fixed assets minus accumulated depreciation, and that's the net fixed assets. So sales divided by net fixed assets for 2017, we get 8.41, right? So, again, to find out where these numbers come from, these are rounded to thousands, and they come from the mini case at the end of chapter. The sales amount of sales is from income statement, and the amount of net fixed assets is from the balance sheet. So fixed assets turnover is 8.41. Total assets turnover is sales over total assets, and that is 2, right, for this company. And so the fixed assets turnover is expected to be higher than the industry average. That is good. Turnovers, remember, turnovers, we want them to be as high as we can possibly make it. So fixed asset turnover is expected to exceed industry average, but not total asset turnover. Total assets turnover actually is below the industry average of 2.5, right? It's been falling, it's going to fall again. So why is it? What's the difference between fixed assets and total assets? Here's your culprits: accounts receivables and inventory, right? Total assets is current assets plus fixed assets, and we see that fixed assets turnover is good, total assets turnover is not, which means we must have excessive amounts of accounts receivables and inventory, right? And we kind of got a glimpse of that by looking at the inventory turnover, which is bad, and then day sales outstanding, which was also pretty bad. So the question is, does it, now we're looking at other ratios, which is going to give us some clues into the financial health of the company. Does the company have too much debt? Can the company's earnings meet its debt servicing requirements? To get these answers, we're going to look at debt management ratios, right? So the first one is basically total debt over total assets. That's called the debt ratio, right? And from 2017, if you look at the balance sheet, the total debt is going to come from notes payables in the balance sheet on the liabilities and equity side. Notes payables, that's where this 300 comes from, and long-term debt, right? So notes payables and long-term debt, which is even 300,000, 500,000. But that's the total debt. Take those. Now, just a reminder, notes payable is also a debt that is due within the next year, so it gets classified as a current liability. But it could have been the money that was borrowed 9 years ago. It was a 10-year loan 9 years ago, but now it only has 1 year left, right? So it gets classified as current asset. That's notes payable plus long-term debt is the total debt. Take that, divide by total assets. This is for 2017 again, and we get 0.227 or 22.7%. Then another leverage ratio is liabilities to total assets. So you look at total liabilities and divide it by total assets, right? And so for total liabilities, basically from liabilities and equities side, we're gonna look. We're gonna get the 1,039.8, basically 1.0398 million. That is the current liabilities plus the long-term debt, 500 for 2017. So those are total. Those added up gives us total liabilities. Divide that by the total assets, which is basically you can get from the bottom of either side, the asset side or liabilities and equity side of the balance sheet. But that gives us 43.8%. So that's the liabilities to assets ratio. Right? Another useful measure is this times interest earned, right? So interest represents our fixed costs, financial cost. Interest on debt must be made when they are due, right? Otherwise, the creditors have the right to demand payment, even foreclose on assets. So that times interest earned tells us after meeting our operating expenses from our sales, right? Sales minus all the operating expenses is earnings before interest and taxes, right? So our operating profit, this is the operating profit. Is our operating profit enough to cover our interest expense? So we would want this ratio to be at least 1, preferably more if we want the company to be profitable, right? For 2017, earnings before interest and taxes was 2.6 in thousands, divided by 80,000 in interest expense, and we get times interest earned ratio of 6.3, which is actually pretty good. Then there's an EBITDA coverage, right? EBITDA is earnings before interest, taxes, depreciation, and amortization. Actually, we have earnings before interest, taxes. We add to it depreciation and amortization, and we add to it any other fixed payments. And we had seen that in the other information that was provided to us that there were $40,000 in lease payments that doesn't appear on the balance sheet or income statement anywhere, right? So, but that is a fixed expense, just like depreciation is. So we take EBIT, we add depreciation, we add any other fixed expense like lease payments, and then we divide that with all of our obligatory payments, financial payments, which would be interest, lease, and loan payments, right? Any of the loan that is maturing that will need to be paid this year. So anyways, so we take the interest expense 502.6 plus add the depreciation 120,000, add lease payments 40,000, divided that by interest expense of 80,000 and lease payments of 40,000, and there's no loan payments that are due this year, so that's a 0, and we get an EBITDA coverage of 5.5 years. Okay, so now what the company had done during 2017 was to sell a lot of new stock, right? We saw that 250,000 new shares had been sold, and used some of that money to pay off the outstanding debt. And so basically the company has changed its debt to equity mix. And we can see that from the balance sheet, value of equity and value of debt, but also the mini case gives us the scenario, and what is being done is recapitalization. So the company has recapitalized its finances by injecting more equity and reducing some debt, right? And what did that do? Well, it definitely led to a dramatic fall from 2016 to what we expect in 2017 due to the recapitalization of the debt ratio, decline in the liabilities of equity and to assets ratio, and enhancement in the times interest earned ratio. With less debt, there's less interest payments, right? And also an enhancement in the EBITDA coverage ratio. And basically, we see that the debt ratio and liabilities to assets ratios, they actually improve to the extent that it's better than the industry average. Times interest earned is also better than the industry average because we're looking for that to be high, right? How many times the interest expense is being covered by operating profits. But EBITDA coverage ratio is much lower, still much lower than the industry average. Again, that we need that to be high. So recapitalization improves the situation, but lease payments drag down EBITDA coverage ratio, right? So difference between TIE and EBITDA coverage comes from adding the lease payments. Then finally, we're going to look at some profitability ratios. What's the company's rate of return on its sales, on its assets? And so we're looking at profit margins. There's a net profit margin, which is simply the net income over sales. You're looking at the income statement. At the very bottom is net income. At the very top is sales, right? Take that ratio and you get 3.6% in 2017 for Computran. Operating profit margin is earnings before interest and taxes over sales, and that's operating profit over sales, and that is 7.1%. Then the gross profit margin is sales minus the cost of goods sold divided by sales. That's the gross profits. It's 7036 minus 5800 over 7036, and so this is just cost of goods sold and doesn't include depreciation or anything like that, just the variable cost. And the gross profit margin is then 17.6%. Well, of course, we've seen that the profit margins had declined significantly. As a matter of fact, net profit margin was negative because net profit was negative in 2016, right? But with the changes being made, we expect it to go improve. The net profit margin will be, and the operating margin, they both are going to be up to par with the industry average. Gross profit margin is even better than the industry average. So it was very bad in 2016, but it's projected to meet or exceed industry average in 2016. Then basic earning power, right? And that's basically a reflection of how we're using our assets, right? A company uses assets to make money, to earn profits, and the company is using its assets, such as machines, factories, etc., to make products and services and sell them, right? And so we look at the basic earning power, which is based on the total investment in the company's assets. right? And that's operating profit over total assets. So EBIT is our operating profit, right? Divided by total assets. EBIT over total assets in 2017 is 14.3%, right? Basic earning power is just operating profits. It removes the effect of taxes and financial leverage, right? So it removes EBIT's earnings before interest, which is, which comes from financial leverage by borrowing money, and earnings before interest and taxes. So we're taking taxes again, not under the company's control for the most part. So it's useful for comparison. What you see is the basic earning power for the company will improve in 2017, but it's still well below the industry average. So there's still a lot of room for improvement. Then return on assets, right? That's net income over total assets, and that's the company's, bottom line, which is, so it's the bottom line of the income statement, which is the net income, divided by total assets. Again, total assets will come from the balance sheet, and the return on assets for the company is 7.2%, and return on equity is same again. The bottom line from the income statement, net income, divided by total investment in equity, and that is total equity, which is going to be, which is going to be common stock plus retained earning. We add those, and you get total equity. And so net income over total equity for Computran is 12.8% in 2017, right? So when we look at return on asset and return on equity, well, they're both, even though they improve, they're both lower than the industry average, right? So there's still room for improvement, but at least they tell us that the company is going to be profitable. So return on assets is lowered by debt. Interest expense lowers net income, right? So net income bottom line is of the bottom line of the income statement that is impacted by interest payments, right? So if the company has a lot of debt, there'll be a lot of interest expense, and the net income will be lower. So the return on assets will be lower. But if the company has a lot of debt, that means it has less equity. So the return on equity, which is net income divided by return on equity, it's the impact of the use of debt on ROE can be different, right? If equity is lowered more than the net income, then actually ROE would increase. So typically what happens is for a company, they're up to a point adding debt. Let's say a company starts with zero debt, and then it starts to add debt to its capital structure. And at first, you'll see that it's actually going to, if the company is profitable, it has positive ROA, its ROE will be higher than ROA, and it rises in proportion. It rises more as you start adding debt. It rises, ROA stays, actually declines by adding debt because you're adding interest and net income is declining, but at first ROE will increase up to a point. Then after that, adding debt actually becomes too risky, and then we will see that ROE will not rise, but rather decline. So then we look at market value ratios, right? So market value ratios actually takes information from the balance sheet as well as from market prices. So high current levels of earnings and cash flow increase market value ratios. High expected growth in earnings and cash flow increase market value ratios, right? So having high levels as well as high growth in earnings and cash flow will increase market value ratio. High risk for expected growth in earnings will decrease market value ratio. All right. So because market values are based not just on the levels of cash flows in the future, but also on the risk assessment of those cash flows, right? So there's a couple of market value ratio. The stock price was 12.17 in 2017. Earnings per share is net income divided by the number of shares outstanding. Net income was 253.6 million. 253.6 thousand. These numbers are in thousands. And the number of shares outstanding was 250,000. And so earnings per share is $1.01. Actually, this number was given to us in the extra post-balance sheet information. But what the price and earnings ratio, PE ratio, is price per share divided by earnings per share, right? Which is the 1217 divided by 1.01, which is approximately 12. Let's see. It's I think there's the slide's been cut off, but 1217 divided by 1.01 gives us 12.05. If we round it to 2 decimal places, it would be 12.05. All right, so that's the PE ratio. Likewise, we can calculate the price to cash flow ratio. To get the cash flow per share, we take the net income and add back the depreciation, because depreciation was subtracted to get to the proper amount of taxes, so we could calculate the proper amount of net income. But it's not an actual cash expense, so we add back depreciation and then divide that by number of shares outstanding, and we get 1.49. That's cash flow per share. Then take the price per share of 1217, divided that by this cash flow per share we just had, 1.49, and we get 8.2. 8.2 is the price over cash flow ratio. Okay. Then market value to book value. Well, for that we need to calculate book value per share. And so we take the amount of common equity, right? And of course that is your common stock and retained earnings combined, the amount of common equity divided by the number of shares outstanding, and you get book value per share, which is 7.91 for 2017. Well, so the market to book value is simply market value per share divided by book value per share. So price per share was 1217. That's the M here. Same thing that we had called P in other ratios, right? That's the M, 1217, and book value is 791. So we get market value to book value of 1.54. So what do these ratios basically mean? The P ratio tells us how much investors are paying for each dollar of earnings in this company. And if it is higher, that means the company has pretty good future outlook. Right? People are paying for not just current earnings, but for future growth. Market to book value tells us how much is paid for a dollar of book value, and book value is basically for the stock that was sold to investors. And once again, we want to find out how much it is. We want it to be higher, but that's because that's the value added, right? Book value is the value that was contributed by shareholders into this company, and the market value is the value, the total value. So the difference will be value added. So PE ratio and market book value ratio are high if the return on equity is high, right, and risk is low, both. Right. So a lot of times people will say, just look at the PE ratio and buy stocks with high PE ratio. Well, they're ignoring one thing, right? They're ignoring risk. So if the risk is high, then of course you don't want to buy that stock. Okay, so let's look at these ratios and how they compare to the industry average. The PE ratio will improve to 12. Price to cash flow ratio actually falls, right? And market to book value ratio improves. But a PE ratio is all of these ratios, right? The PE ratio remains below the industry average. Market to book value ratio remains below the industry average. But the price to cash flow ratio is better, right? So the P ratio and B ratio indicate that market doesn't value this company as highly as it does the average firm in the industry, although we get the opposite signal from the price to cash flow ratio. So sometimes you just go with the majority of the signals you're getting, right? Now, another way of looking at a company across time, so is using common size balance sheets, right? So we're not going to compare this company to other companies or the industry average. We're simply going to see how its performance has improved or declined over time. So one way to do that is to look at common size financial statements. So here's a common size balance sheet, right? And what is common size balance sheet? Well, we simply take the largest item. In balance sheet, it's going to be at the very bottom. It's the total assets, right? The total assets. And we basically make everything a percentage of total assets. So for 2014, cash was 14,000. Sorry, for 2017, cash was 14,000, and total assets is 3.516 million or 3.517 million. Sorry, thousand. Sorry. So it's going to be 14 in thousands. 14 divided by 3.517, and we get 0.0039 or 0.004, right? 0.004 is actually 0.4%, right? So that's how we get that number for accounts receivables, right? Accounts receivables is 878,000. So we do 878 divided by 3.517. We get 0.2496, or around 25%. So that's how we get this 25%. So that's how all of these numbers are calculated. They are a proportion. So 23.9% in accounts receivables is in 2015 says that in 2015 the company had company's accounts receivables were 23.9% of its total assets, the value of its total assets. In 2017, it was 25% of its total assets, right? And then we can also look at the industry averages for comparisons with common size balance sheet. But common size balance sheet is more useful to compare across time, right? We can see accounts receivables actually went up to 25%. It's going up. Inventory is going up as a percentage of total assets, and that had shown up in the inventory turnover, right? And some other ratios that we had seen before. And here's the other side of the balance sheet, liabilities and equity side, and we're doing the same thing to get common size statements in the liability side, right? So it's just proportion. You take the value of notes payable divided by the value of total liabilities and equity, and you will get the percent, right? And of course, at the bottom, total liabilities and equities will always be 100% because that's our base. And for good measure, throw in the industry averages as well. And what those common size balance sheet income statements showed us that Computron has higher proportion of inventory and current assets than the industry, right? Go back here, and higher proportion of inventory than the industry of 41.2%. Current assets much higher, 76.2% compared to 64.1%. All right, let's see what else. Computran now has more equity, which means less debt than industry. But that was the whole plan, right? Recapitalization plan. And when we go back to the liabilities and equity side, we can see that the Computran has more equity, 56.2% of total assets, whereas in 2016 it was only 19.3%, which means it had a lot of debt, right? But now it's going to have less debt because we did this recapitalization plan. Computran has more short-term debt than industry, but less long-term debt than industry, right? So we could see that again, long-term debt, so 14.2% compared to 26.3%, so it's a lot less. Whereas the short-term debt, which is note payable, 8.5% compared to 2.4% for industry, so it's got more of that. Now we move from balance sheet to income statement, and the common income statement, the largest item is actually the top line, which is sales. So we make everything proportional to sales. So take the dollar value of cost of goods sold, is 5.8 million. This is cost of goods sold. 5.8 million divided by 7.036 million, which is sales, and we will get 82.4%, and that's the proportional of cost of goods sold. Cost of goods sold have gone down relatively lower than the industry, so that looks good, right? And everything else is in proportion. Interest expense goes down. It was 3% in 2016 because we have a lot less debt now. The interest expense goes down to 1.1%, which is at par with the industry average, right? The bottom line, the net income, the profitability of this company now is at par with that of the industry. The net income is 3.6%. Anyway, so we see that Computran has a lower cost of goods sold, but higher other expenses. So its EBIT is similar to that of the industry. EBIT is the operating profit, right? Oops, I hit the wrong button. Let me go back. EBIT 7.1%, and the operating profits is the same as that of the industry, and the net income is the same as that of the industry. And that's because even though cost of goods sold is lower, these other expenses are much higher. All right, then we're going to look at what's the amount of change in percent. So between 2015 and 2016, sales went up by 70%, right? And how are we going to get that number? Well, 2016 sales were 5,834,400. So 5,834,400. Divide that by 2015 sales of 3,432,000, and you get 1.7. So that means that sales are 170%. In 2016, sales are 170% that of 2015 sales, which means the growth was 70%, right? And likewise, growth from 16 to 17 is 105%. So we're looking at a massive improvement in sales, right? So of course, as sales goes, costs will also grow. In 2015, costs grew much more than sales, but in 2017, the costs will grow less than that of sales. So we've got a little bit of cost control issues that is being taken care of. Then EBIT, if we look at EBIT, well, it had declined and now it's supposed to improve a lot. So that's a good sign. And net income had declined considerably, but this is going to improve and become a positive change. So those are good signs, right? So Computron is projected to become more profitable in the future. Do the same thing, percent change analysis and the balance sheet. And basically what we're looking at is the cash improves. The cash balance had declined in 2016. It's going to improve. Inventory had declined in 2016. It's going to go up, but that's actually not a good thing. We don't want to carry too much inventory. Accounts receivable goes up. You know, it had gone up only 80% in 2016. Now it goes up by 150%, much more, and that's not a good sign either. Right? Well, so current assets grow by actually total current assets are going to double, and they'll be growing twice as much, about 70% to 140%. Right? That's not looking good either. On the liabilities and equities side, we're looking at growth. What we see is that short-term debt, its growth is going to be much smaller than it has been in 2016. Right? Long-term debt, again, growth is going to be much smaller than it has been 2016 because basically we have issued some shares of stock, used equity to pay off debt, right? That's the recapitalization. And so total equity goes up by 197%, and that's the part of the recapitalization plan. So we see total assets are projected to go 139%. Sales are only growing 105%, that came from the income statement. So asset utilization remains a problem, right? So we look at this thing called the DuPont equation, and the DuPont equation focuses on sources of profitability, right? So expense control, profit margin, asset utilization, which is total assets turnover, and debt utilization, which is basically a sort of a debt ratio. So it'll show us how these factors combine to determine the ROE. So ROE, if you remember, ROE is net income over total assets. So if we take the profit margin, which is net income over sales, multiply it with total assets turnover, sales over total asset, and then multiply it with the equity multiplier, which is total assets over common equity, right? So what's the difference between total assets and equity? It's debt. So it's kind of like a debt ratio, right? And the higher this number is, the more debt the company has. And of course, if we do this multiplication, well, here we have total assets in the denominator and the numerator that cancel out. We have sales in the denominator and numerator that cancel out. We're left with net income over common equity, and that's the definition of ROE. But the DuPont equation takes the ROE and breaks it down into its components, which point towards sources of value, right? So in 2015, the ROE was 13.2%, and we got 2.6% was profit margin, right? 2.3% was total assets turnover, and 2.2% was equity multiplier. So that's the financial leverage part, right? And which adds the value. If you have high levels of financial leverage, then profits will be magnified, but losses also gets magnified. And we can see that in 2016, 5.2, we had much higher, equity multiplier, much higher amount of leverage. That year, the profit margin is negative 1.6%, right? Turnover ratio is 2%, but that negative profitability got magnified, and the return equity is minus 16.6%. So for the stockholders, a negative 1.6% in profit actually looked much worse because of this high amount of leverage. In 2017, we have much lower amount of leverage. Company is profitable, and so ROE is higher. The industry average, well, has the same profit margin. They have higher turnover, so we're looking at low total assets turnover for this company, right? And the industry has higher debt ratio. And once again, the way the debt ratio works is that this is the equity multiplier. It's a form of debt ratio, but more debt means any positive profits will get magnified. So will any losses or negative profits. That gets magnified as well. So the ROE for the company is actually lower, much worse than the industry average. Of course, so we can draw conclusions about a company and compare it to other companies, but there are some limitations of ratio analysis, right? And we can't use industry averages for a company which doesn't strictly operate in a narrowly defined industry. So if the company has many divisions, it's got many different kinds of businesses, well, it'll be difficult to make those comparisons. Seasonal factors can distort ratios, right? So we're looking at some companies do much better business in Christmas seasons. Others do much more business, are more profitable in the summers. And you can think about, air conditioning business, for instance, right? So the ratios can be different in different seasons. Window dressing technique can make statements ratios look better, and this is something that even under the guidelines of generally accepted accounting principles, you can actually make changes like how you count inventory, right? From LIFO, last in first out, to first in first out, which is from LIFO to FIFO, and do some other things like you could sell some assets and generate cash for the year. Of course, that would mean the next year you won't have those assets to work for you, and it's going to be worse over the long term, but for the short term, such window dressing can make ratios look better. Different accounting and operating practices can distort comparison, and that's more relevant when we're looking at this global economy and we have companies operating in different countries, and of course we have global companies that have operations in many different countries at the same time. And there's some qualitative factors to consider which may not be covered by these numbers in the ratio analysis that we look at, right? For instance, there's greater risk if revenues are tied to a single customer. So if all of your sales, your tire manufacturer on all of your sales are to Toyota Motors, well, then there's quite a bit of risk if Toyota Motors has problem financially, or they simply decide that you're not the customer, I'm sorry, that you're not the supplier they want, something like that. Of course, that's kind of stuff does not get captured in ratio analysis, right? So if the revenues are tied to a single customer or a single product, if you just make and sell one thing, that thing could become obsolete next year or go out of fashion, right? And be replaced by a better thing. Just like relying on a single customer is bad, relying on a single supplier can be bad, right? That increases the risk. And of course, what proportion of your business is being generated in domestic markets versus overseas market, that could lead to higher risk. Other factors to consider is, what's the competitive situation for the industry as a whole? What products are in the pipeline, right? Legal and regulatory issues and how to deal with them. So those are the factors that could impact a company's prospects in the future, but they're not captured by the ratio analysis that we have gone through in this chapter. Well, with that, we are at the end of this chapter. I'll be back with more lectures. In the future lectures, we will not be using the mini case, but rather I'll bring my own slides.